Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of Geodata Vision.
Good morning, everyone, or good day, I should say. This is Len Suzio with Geodata Vision, and I'm having another interesting discussion with Dean Stockford of M&M Consulting. Dean, what's on tap for today's discussion?
Hey, Len, it's great to see you. I can't believe we are rapidly approaching the year end, and we've done well over 100 episodes. With large percentage of folks now using electronic means to access banking services and funds, I thought I'd talk about some common violations that we're seeing with error resolution processes under Reg E, electronic funds transfers.
Well, you know what? That's a great topic. In fact, I've had some issues myself personally this last year with one of my banks. So I'm certain our audience and I will appreciate it very much.
Yeah, well, first let me set the table. The Electronic Funds Transfer Act establishes basic rights, liabilities, and responsibilities of consumers who actually use electronic funds transfers, remittance transfer services, and of financial institutions or other persons that offer these services. And, the primary objective of the act and this part is really the protection of individual consumers who engage in those electronic fund transfers or remittance transfers. And this part applies to any electronic fund transfer that authorizes a financial institution to debit or credit a consumer's account. So the term electronic funds transfer means any transfer of funds that is initiated through an electronic terminal, telephone, computer, magnetic tape for the purposes of ordering, instructing, or authorizing a financial institution to debit or credit a consumer's account. And the term itself includes, but it's not limited to, the types of things that, of course, we are experiencing every day, which are point-of-sale transfers, automated telemachine transfers, direct deposits or withdrawals of funds, transfers that are initiated through a telephone, of course, transfers that resulting in any type of debit card transactions, whether or not initiated through an electronic terminal or not. So now that we understand what the coverage is, and of course the definitions and some background around electronic funds transfers, let's jump into the common violations we're seeing.
Let's proceed. I'm all ears.
Okay. Yeah. So let me, again, the first issue I think that we're seeing, which when FIs actually fail to apply liability properly, they apply the limits wrong. And we also deal with timeliness issues as well, because again, banks are under very strict timeframes for responding to errors in the event that one occurs or has been initiated as being unauthorized. So when a consumer asserts those unauthorized transactions that occurred, more than 60 days after an institution transmitted the periodic statement listing what the disputed transaction is, the institution isn't required to follow the error resolution requirements. And this, has to do with whether or not things actually have to be in writing or not, or whether they're initiated because you saw it on your periodic statement. But a consumer must report that unauthorized electronic fund transfer that appears on the periodic statement within 60 days of the financial institution's transmittal of that periodic statement to avoid liability for any what we call subsequent transfers that occurred outside of that. So otherwise, the consumer faces unlimited liability for all unauthorized transfers that are made after that 60-day period. So just for the consumers that are out there, it's imperative that they look at their statements for purposes of recognizing whether there's been any type of transaction that doesn't look like you conducted it. In other words, falls under the unauthorized access rules.
So, Dean, I just want to clarify one thing. So the 60-day period starts not from when the transaction occurred, but from the date they received the periodic statement from the credit card company or whomever?
Yeah, fantastic. Not the credit card company. This would be from the bank. The rules are slightly different when we're talking about credit cards. This is strictly your debit cards that we're talking about here from the financial institution themselves. So, but you are spot on, Len. That is the case. That
Good.
that it's 60 days of the periodic statement. So once they have sent out that periodic statement, that's the consumer himself will limit their liability for any future or other types of transactions if they identify the unauthorized access within that period of time.
I'm going to push you just a little bit more on that. So, is it when the statement is transmitted or when it's received that the clock starts ticking?
It's technically when it's received from them because they have that
Okay.
period of time to actually, view the statement and then act on it.
Right. Okay, great. I'm telling you, I'm going to be all ears, like I said. So, so, Dean, maybe you can provide an example of what you're talking about to clarify things for our listeners.
Yeah, I think that it's a good idea, Len. So let's just say the consumer loses his or her card on January 1st of 2026, and they notice that it is missing on the same day. On the next day, January 2nd, a transaction or a 500 unauthorized transaction occurs. And 2 days later, another unauthorized transaction of 500. So the financial institution then includes these transactions on the periodic statement that was sent to the consumer on February 1st when the statement was generated. On April 15th, 2026, an unauthorized transaction is made for another $700. So the consumer notifies the financial institution of the lost card a day after that last transaction on April 16th of 26, which is more than 60 days after the periodic statement, which included the unauthorized transactions that occurred January 2nd and January 4th. So the total liability of the consumer is as such. $50 for the 500 unauthorized transaction that occurred on January 2nd, because the liability is limited to the first to $50. $450 for the $500 unauthorized transaction that occurred on January 4th, and $700 for the unauthorized transaction that occurred on April 15th. Examiners have found that financial institutions believe the timing requirement for error notices also applies to the limits on the consumer's liability for unauthorized transactions. However, when you start reading the official staff commentary for Reg E, it clarifies that while a consumer has unlimited liability for transactions occurring after the 60-day period, the liability limits under a certain, which is 1005.6 of Reg E, still apply for transactions that occurred prior to the 61st day. So that's why they have limitations on the amount, as I stated above. So it's important for the financial institutions to have strong error resolution step action procedures that include, clear guidance for added protection for consumers who are alleging the unauthorized transactions.
You know what? I could see why examiners have found issues. This can get quite confusing, Dean.
Oh, there's no question about it. It gets very confusing, and there's much more. I mean, these are just some of the hotter issues that we're seeing, but there is certainly a lot of timeliness issues as it relates to institutions in their research on unauthorized transactions. But it's imperative staff understand these provisions, create those clear step action procedures, as I noted previously. Given the increased usage of electronic devices, and of course, the uptick in fraud, you can expect that we're going to see some ongoing issues in this particular area.
Well, thanks for discussing this issue and providing the great example that you've done. But are there other issues with error resolution process that you have seen too, Dean?
Yeah, well, seeming how we do have some time, I will certainly jump into some of them. We've seen some additional issues with providing or not providing what we call provisional credit, the timeliness for investigations, not complying with investigation requirements for correcting errors, or after the investigation is final, notifying them of the corrected error with the appropriate notification. So you can see where there is certainly room within the provisions for some errors to occur. And in my experience, the issue I see most often deals with provisional crediting. A financial institution must begin its investigation promptly upon receipt of an oral or written notice of error and may not delay initiating or completing an investigation pending receipt of information from the consumer. If the institution is unable to complete its investigation within 10 business days, the institution may take longer, up to 45 days from receipt of the notice of error, to investigate and determine whether an error occurred, provided that the institution provisionally credits the consumer's account in the amount of that alleged unauthorized error, including interest where applicable, within 10 days of receiving the actual error notice. And that's where we, again, see issues from time to time. Institutions choosing to extend the error investigation period beyond that time frame of 10 days or 20 days, of course, for new accounts that are just open, generally must provide provisional credit within 10 to 20 days, provided that none of the exceptions under the rule actually apply. And there are exceptions. I'm not going into those today, but I would certainly encourage folks to look at what those exceptions are to Reg E. More recently, examiners have identified many instances in which an institution has taken more than 10 business days to investigate the error when an exception to providing provisional credit does not apply, but fails to provide provisional credit or does not provide it in a timely manner. And a lot of this deals with, I always say, policy relative to whether they receive something in writing or not, because you remember it's oral or written. So some delay it because they require the unauthorized notification or error assertion to be in writing. You can't delay. So it's important that they, of course, start their investigation promptly. And if not, if they can't complete that within that 10 business day period, provisional credit should include, both the amount of the alleged error and interest whenever is applicable.
This is great information. I actually didn't realize how strict the provisions are with regard to timeliness, and I'm certain our audience got a great deal from today's topic. So I want to thank you, Dean, for another great educational presentation.
Well, thank you, Len. This is Dean Stockford from M&M Consult.
And this is Len Suzio from Data Vision saying thank you for listening to today's topic, and please let us know of additional topics you would like to hear in future episodes.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and Data Vision on LinkedIn for all the latest news and information on compliance hot topics.